Alright, what's up guys? Today I'm going over the top mistakes I see beginner investors make. So here's my profile, I got 1,000 followers, and here's my stock portfolio with about almost $10,000 in. So the number one mistake I see is fearing recessions, guys. Fearing recessions. So when I was a beginner investor, what I was thinking, I was trying to invest in these blue chip value companies, these safe companies like Procter & Gamble or Johnson & Johnson right here we have in the health. So we get in the health stock sectors, we get in the consumer cyclical sectors. So we look in the 1 year, guys. We are totally missing out on growth with these safe stocks. So, of course, you're looking for longevity and for it to be more stable in the long term, so they don't go too much down in recessions, as you can see, because we're looking here, even in 2008. But we're missing out on the growth here, guys. Recessions, they may or may not come. People post videos about recessions. Oh, World War III is going to happen, but we can't be scared in the stock market. Growth is our number one option when we are young. We have time and longevity in the stock market. So another big one I said is Procter & Gamble. Like I said, they're a blue chip company. They have a dividend. I'll get into dividends later. Dividends can be largely a trap. But we're getting in Procter & Gamble. Seem -5 in the year. And it is 37.32 in the 5 year, but let's go to something like a Charles Schwab growth ETF, which screens for growth. So when we look at a growth screening, in the same 5 year time period, you get 128% with a large variety of multitude of ETFs in the stock basket rather than just one safe stock, and you can just go in there. But if you were looking for like something like an health stock, consumer cyclicals, I would recommend is what I made a video on earlier, is VFLO Victory Shares free cash ETF. This actually has a 26% moat in healthcare here, you see, and a 20% in consumer cyclical, just like Procter & Gamble. Then you have energy and utilities, which are also one of the safer ones, and basic materials, of course, that's really safe here. And then we look in the 1 year, it's actually good performance. It's performing just as well as SHD. You go back here. It is relatively new, but that's why I like it. SHG, of course, is 14, but if we go something like a QQQ, which is the NASDAQ, which is hold all the top technologies stocks, actually probably, I think it beats it out. If you look at it here, yep, 13, close enough. But it actually spreads your risk out. So another thing, the next one I want to talk about is another big problem I see with new investors is they get the wrong version of diversify. So when you talk about diversification, so a lot of people advocate for VT, which is the worldwide index here. So look at this. Let's go into the 5 year. 70%. Okay, that's not bad. But what we're doing is we're taking away from what matters. The U.S. large cap stocks. Those are what push the growth. So we are putting a small percentage, like 15%, in outward, like China, Asia, India, those other economies. But we're thinking it's safer, right? Because if the United States has a recession, then or if it goes down, then we have the other international stocks that can keep us afloat. But the thing is, in the long term, the U.S. stocks are going to do way better than all the other stocks. So there's no reason to have it. So if we just go to VU, the S&P 500, which is the top 500 stocks we have here, then we're going to really see in the 5 year how much we're missing out here just because we're investing in a small percentage of international stocks here. So 99.33, that's 99.33. So we're missing out on like 20-30% just because we're investing in international stocks. So you're saying, oh, so we should invest only in United States stocks. Well, I like to pick and choose because, as you see here, I have ASML, which is a monopolistic company that has in the chip industry, lithographing chips. I even have, what else do I have? In the international Brookfield Corp, which is kind of like the Berkshire Capital of, so with Warren Buffett of Canada. But back to the point, just stay away from these wide variety. Just if you really want to invest in one thing, VU or SPLG, S&P 500 is what I'd recommend. Same thing for VTI. You say, oh, I don't want international. I want the U.S. stock market. I want diversification. So I'm going to diversify inside the United States. Well, it's totally, this is the includes small caps. So we're missing in the 5 year and maintaining small. We're missing out on 5% just because we're diversifying small caps because the small caps underperform the large caps in the long term. So, like I said before, What is your other option? Well, like I said, VFLO, right here. I made a video on it. It's also large cap stocks in the United States. Because the other reason I think it is people just want to diversify into technology. So instead of VU, they go on something like I said, SCHG, or the more popular QQQ, NASDAQ 100 stocks here. The top 100 technology stocks. Of course, they're going to outperform the VU, 121.57%. But the thing is, we're going into 52% technology. It's ran up so much and has a P ratio of 33.4 PE ratio, which is price to earnings here. Out of all the stocks in there, it holds a similar stocks as S&P, Microsoft, Nvidia, Apple, Amazon, Avago, Meta. Those are literally the top same exact 5 holdings. So you're putting large money in one place in technology. And if you want to be more, that's okay if you're young. But if you're more conservative over time, you should diversify in something else. So like I said, that's why I want to get into VFLO. It's getting the same amount as a growth stock because it's free cash flow, which I made a video on. But when you're going in the holdings here, the holdings are loading, you get something different stocks. You get different diversification. Exxon, Citigroup, Mero stocks, General Motors, Qualcomm, even energy stocks. It's more diversified. So I'm not saying to put all your money in here, but I'm saying if you're going to already diverse in VU and the NASDAQ, you should add this too. It was like a 5-10%, something in there just to get a different diversification in, and you're in large caps. So you're totally, you're doing the right thing. You're not doing in international stocks. You're not doing in small caps. You're just getting straight to the large cap points, and you're doing in quality companies because this screens for free cash flow, which is my favorite metric. There's another one, JQuA, which is quality factors, which I'll make a video later. But let's get into the younger investors here. So what is our number one thing? So there's a bunch of Blossom is an amazing platform here. Blossom is an amazing platform. But we have a lot of people that are advocating for dividend investing, and they're older folks. Oh, dividend investing is great for older folks. But if you're younger, underneath 40 years old, you should not be doing dividend investing unless you really take out that income to use. You should not be using dividend investing. So here's an example of a popular one, JEPI. It's a premium. It writes covered calls, which basically, I don't need to get into it. Basically, it has an extremely high dividend yield of 8%, which is high. So that's one of the reasons. But if you look in the year, it takes away from the actual growth because you're missing out on that 20% growth of the S&P just because you're trying to get the dividend yield. And this is technically a safer play because it's writing it against the S&P, so it can be safer, but we don't want those safe plays. We want growth when we're younger. And that's what I said when we talk about recessions again. Do not be afraid of red days in recessions. It's basically like you're going to a supermarket and your favorite cereal is on sale. It's the same exact cereal, but it's on sale. So why wouldn't you buy? Are you scared of something? But that's another mistake I'm going to go over here. That's another mistake. Let's go. What I learned from 2024. Let's go on my post. What I learned from 2024. So it's the fundamentals are essential. What am I talking about that? It's you have to invest in companies that are going to survive these recessions. These large cap companies that have good fundamentals, strong game plans, strong business models like Amazon, S&P Global, Visa. Companies you've heard of largely. But the thing is, people try to find. That's another thing. People try to find stocks that are undervalued or not the top dog. And the thing is, they're going to end up losing money in the long term because the famous thing that Warren Buffett said is you let your winners run. Even when you're a short-term trader, people tend to sell out. You have to let your winners run. That means the top dogs are going to keep continuing to be the top dogs most likely. But you have exceptions like Intel, which totally dropped. It was a top dog, but you can totally you can avoid that if you really wanted to by investing in something like here, the index funds or ETFs or diversifying into all these assets. So even if for some long shot Amazon did drop, it's probably more like 11% in my portfolio right now. I wouldn't be at a total loss because of all these great stocks here. Do your own research. People like to watch YouTube videos and stuff, which is great. That's doing research, but you don't want to someone just says, "Oh, I want to buy a stock." You don't just buy a stock because someone else said it. And also FOMO, something like Palantir. It's great FOMO. They're getting it now. It's extremely high PE ratio or Circle stock. Circle, a lot of FOMO there. But the thing is, when the stock gets overvalued, it's overvalued. Yes, Palantir is probably going to run up more, but you can't just get in because everybody else should think you're going to miss out. You got to do your own research. Stay consistent. You gotta always put money in over time. So when you could these in the short term, you could totally lose everything. But if you stay consistent, you will never lose anything. So your success in the stock market, 1 year of making gains, 73%, and then 2 year 80, and then it goes over and over and over until like 10 years. You have like a 99% chance to make money in the stock market. That's because even if it does have a recession, everything falls down, you have to buy into that. And if you have quality companies like I'm holding, like Amazon, like Meta, like ASML, or like Uber, if you have quality companies, they are going to survive the recessions. And the thing is, when you put money in the low, they will go up again. But if you have terrible companies, or you're looking for these undervalued companies or something like that, and they don't survive recessions, they're going to tank all the way and they're not going to come back up again. So that's really why you got to do the fundamentals. Don't sell into fear. It's okay to take advice. Investing is okay, guys. Don't let your emotions come into play. That's really a hard one. If you're like just want to set and forget it, just put it in S&P. But that's a big one. Let me go back to dividends here. We have the Japan Income ETF. So another thing I hear is SCHD. It's actually the second most popular ETF in Blossom for people that are holding, because there's mostly like older folk in there. But when I see a lot of younger people hold this, it's like there's even a 13-year-old on Blossom that's holding. Like, you don't need to hold this. Its dividend yield right here is 3.97. Okay, 3.97. And we're missing out on all this growth. Okay, it's a good, right? But that's why we have a Roth IRA. Roth IRA is the most popular, it's the most fundamentally valuable account ever in history here, or a TSFA, and you're in Canada. So I have mine right here, my Charles Schwab account, which I have all my stuff in here. But you see, I don't have any dividend stocks. I have a little bit of SCHD, but that's barely anything. That's like $81. My total portfolio is $10,000. The thing is, you have the power of tax advantage account. You start young, you invest, you can go crazy. I would rather you invest in wildly outlandish high growth companies like Hams, even though it dropped 30%, or like Palantir, than you just go straight into high yield dividends or dividend paying ETFs. Because why? Because you're missing out on the growth. Yes, you reinvest it, but the thing is, you can transition your Roth IRA into a dividend. Let's think about it. I'm 18. I'm growing my portfolio. I have all these high growth stocks. I have all these good ETFs, Bitcoin. I hold Bitcoin. But the thing is, when I sell these assets, unlike a regular brokerage account, I don't pay tax. So when I turn the right page of 50 or 59 and a half, I can sell everything and turn it into a dividend. I can do covered calls. I can do SHD and take out the money based on the dividends, which a dividend is a recurring payment that a company pays you for holding the stock. If it's like a blue chip stock, if it's like a valued company, and they have extra cash to pay out the investors. So I can do that whenever I want to, but right now growth is what I need, because compound interest in the future, let's say the S&P is averaging 8. If I get more than 8, that's going to be even point more than 8 is going to be huge in the long term, guys. And that's another huge thing, investors, is not opening a Roth IRA. $7,000 maximum a year. This thing is the most powerful account you could possibly have, better than your 401k, better than a brokerage. It doesn't matter. Even if you are a trader, even if you're not, even if you're a real estate guy, as people will say, tell me, oh, I do options trading. Well, guess what? You can do options inside of your Roth if you really wanted to. You can apply. Look, you can apply for limited. You can apply for long leap calls. You can do spreads, bull call spreads. You can even do You could probably even do naked puts. Probably not if you have to apply here, of course. But you can do options. And with the short term, if you're doing options, that means you're getting short-term capital gains, which is actually like 30% compared to like a 50% capital gains inside of long-term. So you're getting this 30%, or if it's probably more if you're higher income, 30% capital gains tax plus income tax. You're paying a lot. I mean, you can just do it in your Roth IRA, and you don't want to hold it because you think you're a trader and you think this is for old people. Another mistake I see people making is not knowing how Roth IRA works. They're thinking this is for long term, especially for real estate investors. Like, we are all fancy and high. We want to do real estate. We don't want investments like this. Stock market's crazy. Well, guess what? On average, 8%. And there's things you can do. Like, you can take out your contributions. For real estate investors, you can take out let's say you're young and you want to invest in real estate later. So you put your money in this just to hold it into your real estate. And so you're going to do real estate. So boom, you put 7K, grows to 10K. It grows, it grows, it grows, it grows, it grows. You want real estate. I put in $5,000. I put in $50,000. So you can take out the contributions tax free. And guess what? For first time home buyers, you can take out another 10K tax free for your first time home. So you can take out your contributions and even a little bit of your gains too for a first time home buyer. And we're all going to eventually buy a home. Hopefully don't rent forever. And real estate is another gold market. So that's another thing you can use for options traders, real estate buyers. Anybody can benefit from Roth IRA. And if you don't have this account, you're missing out. I don't care if you can't even afford to put money in here. Just open it in case you do. And even if you have nothing to lose, you can put everything in here and you can take it out the next day. Just make sure you, very important, you talk to your tax advisor or CPA, because there is a specific form you have to do when you're taking it out. Back from what I learned in here, don't sell into fear. No difference between dividend investing and growth investing. Don't just follow dividend. Another thing is when you're looking at dividends, if you're gonna look at different dividend stocks, this is a pretty decent dividend stock paying 5%, but there's dividend traps like T-Mobile or Verizon that pay crazy dividends, but the stock just plummets because that's what dividend traps is, value traps. So the last thing I want to integrate is people look for these undervalued stocks. Like I said, they look for dividend stocks. You don't need to do that if you're a young investor. Just look for the top dogs. Top dogs. Like have all these companies that occasionally have a little speculation play. I'm young, but most of these are the top industry leaders. They're the leaders in the industry. Amazon, ASML has monopoly. Monopolistic companies are the best companies. Monopolistic companies are the best companies. Look at the fundamentals. If you really don't understand any of this, just open Roth IRA and you can just look up one YouTube video, how to invest in Roth IRA. It's going to tell you to put it in the S&P 500, VU or SPLG, which is the S&P 500. You can do that, and you can, if you don't want to touch it, you can set up auto investments. Average 8% a year. This thing's crazy. This thing is crazy. So anyway, I hope you enjoyed this video of the top mistakes I see beginner investors or is any investor doing. So have a nice day, guys. Like and subscribe. Comment down below if you want. I'll keep rolling out videos just because I feel like it.